Nvidia just posted an $81 billion revenue run rate, and Wall Street celebrated like it was Christmas morning. But there is one number nobody is talking about, and that number is $1 billion a month, because that is how much Elon Musk's XAI is currently burning on pure computing power every single month. And the moment that stops, Nvidia has a very serious problem. And that is what nobody on CNBC is telling you. Because if you strip away the AI hype and look at the actual math, what you find is not an unstoppable growth story. What you find is the largest single customer dependency in semiconductor history, and it is sitting inside the most overvalued stock in the market right now. Here's the data. Musk's supercomputer Colossus currently runs on over 100,000 Nvidia H100 chips, with plans to scale to 1 million chips. And right now, a massive portion of Nvidia's data center revenue is not coming from broad organic market demand. It is coming from one man's aggressive infrastructure spending. One man who has a very well documented history of building his own alternatives and then cutting off his suppliers completely. And the math behind XA makes this even more alarming. The company's annualized revenue is hovering around $500 million, while its annual burn rate is pushing $12 billion. That is not a business. That is a bonfire. And the fuel keeping that bonfire burning is not XAI's own cash. It is SpaceX's valuation and Starlink's cash flow being redirected to keep the Nvidia chip pipeline open. So, Nvidia's revenue growth is being partially funded by a different Elon Musk company, subsidizing another Elon Musk company's compute costs, and Wall Street is pricing Nvidia as if this demand is permanent. But here is where the trap snaps shut. Because while XAI is burning $1 billion a month on Nvidia chips, Tesla and XAI are simultaneously developing their own proprietary AI chips, Dojo and the next generation AI 5. And Elon Musk has done this before, exactly this. He relied on Qualcomm chips for Tesla's autopilot system just long enough to build his own. Then, he cut them off. He relied on external rocket components just long enough to build SpaceX's own supply chain. Then, he cut them off. The pattern is not subtle. It is his entire business model. And Goldman Sachs analysts are quietly flagging the same concern. The moment Musk transitions to his own chips, a demand vacuum hits the semiconductor market. The sudden oversupply of Nvidia chips floods the secondary market, and Nvidia's pricing power, the single most important driver of its margins, evaporates overnight. And this is where it stops being just an Nvidia story, because Nvidia is currently trading at 50 times earnings, priced for absolute perfection, priced as if every major AI company on Earth will keep buying its chips at current prices forever. But what happens when the largest single buyer of those chips is actively building the infrastructure to replace them? The answer is the same thing that always happens when a stock price for perfection runs into an imperfect reality. It reprices fast and violently. Because here's the domino chain. XA finishes its internal chip development ahead of schedule. Musk redirects compute spending away from Nvidia. Nvidia's data center revenue growth misses estimates for the first time in 6 quarters. The stock drops 20% in a single session. Passive index funds that are overweight Nvidia sell automatically. The Magnificent Seven gets repriced simultaneously, and your retirement account feels it whether you own Nvidia directly or not. And this is not a fringe scenario. This is the base case if you actually read the filings instead of the headlines, because the AI boom is real. The demand for compute is real. But the idea that Nvidia has permanent pricing power and permanent demand from its single largest customer, while that customer is burning cash at an unsustainable rate and building its own replacement chips, that idea is not real. That is the story Wall Street is selling you, and it is dangerously incomplete. Traditional financial media will not cover it this way because Nvidia going up is a better story than Nvidia being structurally vulnerable. Up gets clicks. Vulnerable requires nuance, and nuance does not trend. The real risk is never the one everyone is watching. The real risk is the one hiding inside the earnings report nobody read. The $1 billion monthly burn. The 100,000 chips that could become zero overnight. The trap that is already set and waiting to snap shut. And that is why I made this channel. Because the threats that actually move your portfolio are never the loud ones. The real threats are the ones hiding in plain sight. If you want to understand what is actually happening in financial markets before it shows up in your brokerage account, hit subscribe and turn notifications on because this story is just getting started.